Good morning, everyone. I'm Wes Burke with Central Coast Lending. Oil is down, bonds are up, and nobody on the lock desk should declare victory before lunch.
As of late morning Eastern, the 10-year Treasury is near 4.68%, down about 5 basis points. UMBS 5.5 coupons are around 99.18 in decimal pricing, roughly 99-06 in bond notation, and better by about 10 ticks. That is a constructive start for mortgage pricing because MBS are participating in the Treasury rally instead of lagging it. The catalyst is another attempt at U.S.-Iran de-escalation. President Trump called off expected strikes and signaled renewed diplomacy over the Strait of Hormuz. Iran disputed the idea that talks were actually underway, so this is not a clean ceasefire story. Still, crude traders removed some risk premium. Brent fell about 5% to the low 83s, and WTI moved below $80. For the mortgage desk, the transmission is straightforward. Lower oil reduces the near-term inflation scare, treasuries rally, and MBS get room to improve. But headline-driven rallies are rented, not owned. Today's economic data tried to spoil the bond party. The ISM Manufacturing Index jumped to 55.6, the strongest reading since May 2022. New orders expanded, factory employment moved back above 50, and the report said manufacturing momentum is broadening. That is not recessionary data, and it reinforces the Fed's argument that policy does not need to get easier. Construction spending told the softer housing story. June spending slipped 0.1%, residential construction fell 0.3%, and single-family construction declined 0.6%. The industrial economy is showing strength, while rate-sensitive housing is still paying the bill. Now, the MBS spread angle. Mortgage News Daily's latest posted 30-year rate is 6.83%, while the 10-year is around 4.68%. That leaves a public mortgage to Treasury proxy spread near 215 basis points. Freddie Mac's weekly 6.66% average produces a spread closer to 198 basis points. Neither is an option-adjusted MBS spread, but both show why a Treasury rally does not pass through one-for-one to a borrower's rate sheet. Lenders still have hedging costs, servicing value, capacity decisions, and margin protection between the bond screen and the consumer. The Fed held its target range at 3.50 to 3.75% last week, but the 9-3 vote was unusually divided, with 3 officials preferring a hike. The latest published futures estimates put the chance of a September hike around 2/3. New York Fed President John Williams said today that he expects inflation to ease, but the Fed is prepared to act if it does not. Translation: oil gave bonds relief this morning. The Fed has not given the market an all clear. The calendar gets more important from here. JOLTS arrives Tuesday, services data hit Wednesday, productivity and jobless claims come Thursday. Friday brings the July employment report. Treasury also announces the August 3-year, 10-year, and 30-year refunding sizes Wednesday, although the actual coupon auctions are next week. That makes Friday's jobs data the clearest scheduled volatility event for mortgage pricing this week. For loan officers, the playbook is simple. First, reprice every active conversation that went quiet during last week's sell-off. Second, do not promise that this rally lasts. Frame today's improvement as an execution window. Third, watch lender reprices, not just the 10-year. And fourth, keep purchase borrowers focused on payment structure, seller credits, and total cash to close. The latest MBA survey showed total applications down 6.4%, purchase applications down 4%, and refinances down 10%. That is not a market with excess borrower momentum. It is a market where timely, specific outreach matters. The bottom line today is better for bonds, better for MBS, and potentially better for rate sheets. But the rally is being powered by oil headlines while the domestic data remain firm. Use the improvement. Do not marry the narrative. One more thing before I go. If you're a producing loan officer, we're building something you'll want to hear about. It's a structured, compliant office access platform that puts the right loan officers inside select real estate brokerages on a published schedule with the brokerage's blessing. You bring the relationships. Central Coast Lending brings the banking platform, the compliance structure, and a formal way to deepen what you already have. If you're tired of being told to go build realtor relationships from scratch and you want a program that formalizes what you already have with a local mortgage bank behind you, give me a call. Let's talk.